We're half an hour away from the open in Hong Kong, Shenzhen, Shanghai. You're watching the China Show. I'm Annabelle Droulers in Sydney with Avril in Singapore.
Our top stories. China's latest PMI numbers out this hour, set to show an economy still struggling for traction despite Beijing's stimulus efforts. A gloomy year-end mood on Wall Street is spreading to Asian markets, with Chinese equities set for a weaker open. Japan and Korea already closed for the holiday. Plus, the US Treasury blames Beijing-backed hackers for a major cybersecurity breach that exploited a third-party software provider.
Taking a look at the market action this morning, and as we said, this is the last trading day for 2024, and we're ending perhaps on a little bit of a sour note, so sort of sets the tone that we've seen for Asian equities over the course of this quarter at least. But generally, when you think about some of the dynamics that we've seen in markets in 2024, it has been, firstly, the Fed repricing coming in the year, thinking we'd see around 7 rate cuts. That obviously has been significantly dialed back. Part of that, of course, is what we see with the Trump tariffs risk, those reinflationary concerns, and also just the expectations, where will China go next year? Particular question marks around their fiscal and monetary policies moving forward. But that is what we're seeing there for Asian equities, ex-Japan this morning, of course, because a number of markets are closed. And actually, let's just take a look at some of those that are already shut or nearing their closure today, because we've got Japan, South Korea, Thailand, the Philippines. They're already not trading today. Half day for Singapore, early close as well. In Australia here, just a couple of hours. New Zealand, and another one to note. So really very, very thin liquidity that has already been sort of the dynamic we've had in trading as well over the past couple of sessions, given we are in that holiday period for many traders as well. But let's take a look at APAC stocks. I mentioned that we've seen weakness today. Well, and the fourth quarter, of course, we're guiding here for losses on a quarterly basis. So it takes us back to saying we haven't actually seen to this sort of magnitude going back to 2022, so a couple of years here. But certainly it is that story, as I said, not only around where the Fed's going to be going, those questions around the AI rally, can that sort of Wall Street rally extend into the next year as well? Uncertainties given President Trump-elect coming back into the White House, those protectionist policies, and what does that mean for China in particular? If you take a look at how futures are setting up for the session today, and we had already seen them sort of looking for a bit of weakness ahead. PMI figures are going to be one very closely tracked, given that also could sort of tell us how much a company's perhaps continuing to front load their orders, Avril.
Yeah, I think those China PMIs are the big one to watch today. Last trading day of the year, both on the mainland and in Hong Kong. A couple of other things we're watching in the Greater China region as well, specifically on levels. Hang Seng, we're watching around the 20,000 region, and this is index that's trading around the 50-day moving average. On the mainland, we've been seeing it pretty tepid for the past couple of sessions. The Shanghai Com is on a 3-day winning streak, but those gains have been pretty mild. We're also keeping an eye out later today, much later today, at I think 7 p.m. local time. Xi Jinping set to give his New Year's Eve address. And of course, keeping an eye as well on the yuan fix. Yesterday, we saw it stronger than estimates by about 1,000 plus pips, but that was little support for the yuan, which still underperformed versus a lot of its regional peers. Now, China's December PMIs are due later this hour, and the latest gauge of a recovery that remains mostly elusive despite stronger stimulus. Our China correspondent Min Min Lo joins us now from Hong Kong. So Min Min, what exactly are economists expecting?
Hey, Avril. Yeah, we are expecting an expansionary print for the PMI in December, but pretty mixed if you compare to the previous month, because the manufacturing PMI is expected to tick down to about 50.2 from 50.3 the previous month. This is largely because of seasonal factors towards the end of the year. And then when you look at the non-manufacturing PMI, that's expected to expand at 50.2 compared to 50 the previous month. This is supported by an increase in travel-related services as well as rebound in construction. That is largely driven by those infrastructure-related fiscal spending. But if you peel back the layers and look at the sub-indices, especially when it comes to the employment sub-index for both the PMI, the manufacturing and non-manufacturing, over the last few months, they have been hovering at around 48 and 45 respectively, so well below 50. That shows us that business are still very pessimistic around hiring, which doesn't really bode well for people's confidence around their income growth, their employment prospects. So again, is that story of weak domestic demand being partially offset by resilient overseas demand, and you see that being expressed in the Caixin manufacturing sub-index. The forecast there, that data is due on Thursday, by the way. The forecast is 51.7. That is an unofficial index that captures export-oriented firm, and we continue to expect these exporters to front-load shipments this year ahead of Trump's inauguration and the tariff risks next year.
Avril mentioned as well, President Xi giving this New Year's speech around 7 p.m. local time. What is there exactly for traders to pay attention to in that?
A short answer is not much. Of course, traders will be looking for some sort of affirmation from President Xi around measures that the government will take to revive the economy. But this is his usual year-end speech where he would usually wrap up the year, just talk about some of the achievements and challenges that China confronted over the past year. He might highlight some of the breakthroughs, especially when it comes to, for example, science and tech or space innovation. He will likely continue to highlight the government's priority, especially in regards to addressing social welfare, because this is an opportunity for him to really connect with the domestic audience and really show that he cares about the bread and butter issues of ordinary people. He will likely also set the tone for next year, perhaps also touch a little bit on China's mark on foreign affairs. But when it comes to the economy, perhaps he might give us a bit more affirmation or confidence about next year's prospect. But really, we're not expecting any sort of market-moving information tonight.
Yeah. Min, also just recap what we've seen so far in 2024 from Chinese markets. A lot of the gains that we've been seeing year to date coming from that September stimulus blitz, but that's fizzled out a fair bit. What are we, paying attention to?
Yeah, I mean, we really started this year with Chinese stocks underperforming the broader Asian benchmark, but that September-induced stimulus-induced rally really buoyed those stocks. And even if they have given up some gains since September, they are still outperforming the Asian benchmark. And if you look at some of the superlatives for this year, the CSI 300, I believe, is in its best year since 2020, the HSI in its best year since 2017, and again, induced by that 19% rally in September. But if you look at the bond markets, that's a different story. Again, that bond bulls really riding high into the new year and yields at record low. That's largely driven by expectations of more interest rate cuts, and it does look like these bond market investors are really lacking conviction that the Chinese economy will reflate on the back of these economic policies. As to what sectors we are looking out for next year, we know the government has pledged more support for the property sector and to really focus on boosting domestic consumption. So if you look at the consumer staple stocks this year, those have been the laggards this year. They're likely to benefit from those policies next year.
That was our Bloomberg China correspondent Min Lo there. And now to some of our other top stories this morning. The US Treasury says it's been hacked by a Chinese state-sponsored actor through a third-party software vendor. A letter to Congress seen by Bloomberg describes the hack as a major cybersecurity incident. It's the latest in a recent string of breaches that have affected US telco systems. We'll have more on that story later this hour. Also developing today is the South Korean court, which has issued an arrest warrant for President Yoon. That's after the impeached leader repeatedly defied investigators' requests to face questions over his martial law declaration earlier this month. If the warrant was executed, he would become the first sitting Korean president to be detained. Yoon managed to block a previous attempt by the police to search the presidential office.
Still ahead, the US dollar ending the year on a high note, but sentiment on the yuan has turned negative again. The FX outlook next with RBC Capital Markets, and we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show. Let's take a look at how Chinese assets are shaping up on the last trading day of the year. We're seeing futures on A50 pointing to slight declines. We've been, of course, seeing a bit of declines, I think, on the Hang Seng the past couple of sessions, however mild. On the mainland, even though we're seeing gains, they also have been pretty tepid. I think not a lot of activity this time of year. Still keeping out on potential for a triple R reduction. But of course, the big one that we're watching later this hour are those China PMIs, whether they show any signs of stimulus working their way through the economy. Dollar China also in focus. We are watching out for the fix in a couple of minutes, but yesterday we did see it stronger than versus estimates by about 1,000 pips, seeing it at 731 on dollar China at the moment. Our next guest is Alvin, head of Asia FX strategy at RBC Capital Markets, for an overview on what to expect for the year ahead, what we've been seeing this year as well. Let's start with the Chinese yuan first, because we've been seeing these tariff threats, obviously a headwind for China, but the domestic economy and Chinese authorities not quite playing ball as far as stimulus is concerned, not helping either. What are you watching out for in the year ahead? What will the main driver of dollar China be?
Well, as you say, indeed, the China's economy is struggling, and that's been the case for more than a year now. So that's kind of in the background that we all know about. The big uncertainty, of course, is going forward, the kind of tariff policies that the incoming Trump administration will put up. I mean, Trump has talked about 60% tariffs on all China imports in the US, which, if imposed, that will effectively end US-China trade. So that's a very extreme measure. I don't think we'll get that because it's such an extreme measure. Nonetheless, I would expect another US-China trade war. And I think that the upside pressure on dollar CNY will persist, and dollar CNY will indeed rise through the 735 high that we've seen this cycle so far.
To what extent? How high do you think we'll go?
My baseline forecast for dollar CNY is that it'll end 2025 at 7.55.
Okay. You said that, we might not see such extreme levels of tariffs, but what will we have to see next year in terms of deal making or negotiation in order for there not to be, these harsh tariffs imposed?
I think certainly there will be, some element of negotiation. But it's worth pointing out that the first Trump administration did put up tariffs against China, and most of those tariffs remain in place. And I would expect the incoming Trump administration to increase the tariffs against China. Now, not to the 60% that he's mentioned, but certainly I think by quite a sizable amount, perhaps even doubling of existing tariffs, I think is quite likely in my view.
So, Alvin, that's sort of the yuan story, but the flip side, of course, is dollar and dollar strength. And how long do you see that persisting for into 2025?
I think the US dollar will remain relatively strong into next year. And there are several reasons for this. I mean, the first is that we think actually the Fed is only going to cut one more time in 2025, as opposed to current market expectations of 40 basis points priced in. So that's one part of it. The other part is that the absolute level of yields remains to the dollar's advantage, significantly so. I mean, the US dollar is one of the highest yielding G10 currencies. So it's certainly higher yielding than, in fact, most major Asian currencies. So that absolute level of yield differential will remain a fundamental support for the dollar. And finally, of course, with the incoming Trump administration expected to pursue looser fiscal policies, immigration restrictions, and of course, some element of trade protectionism, that net effect will also be to support the US dollar. Now, that said, all that said, a lot of good news is priced for the US dollar, and we are doubtful that the DXY index, for example, will break through the cycle high that we saw in late 2022 when it almost reached the 115 level. So currently the DXY is about 108. We think it can move up to 110, 111, but not through the 115 level or so that we saw over 2 years ago.
So then how does that impact then dollar strength persisting? You've got the Japanese yen that has been still weak and that yield differential is very much in play. What are your expectations then for the Japanese currency?
I think that we have reached a new low equilibrium for the yen. So you're absolutely right. The yield differential is hugely against the yen, and it's very hard because of that to be very bullish on the yen, in my view. And because of this, it's really hard to see a persistent turnaround in dollar yen, turn lower in the coming year. That said, on the flip side, of course, is that the BOJ will continue its policy normalization path, very cautious path nonetheless, but still continuing that. And of course, the rate of intervention is real, particularly if dollar yen moves up above the 160 level again. And finally, on the long-term metrics, I mean, the yen is incredibly cheap. I mean, there's so many people I know who've gone to Japan on holiday in this past year, and that tells you how really cheap the yen is. So I think at this altogether, it does suggest that we are reaching a somewhat new low equilibrium for the yen. It's hard to be bullish on it, but I think to push a very bearish yen story is also quite difficult at these levels.
When you look at dollar yen, and perhaps what the BOJ is thinking about it in terms of Japanese financial authorities stepping in to intervene, the difference this time around is that all the Asia currencies are weakening along with it compared to what we saw earlier in the year. Do you think that shifts the dynamics a little when policymakers are thinking about intervention?
I think it does to some extent, but it's also worth mentioning that dollar yen actually trades a lot more freely than many other Asian currencies. So, for example, compared to dollar India rupee or dollar CNY, dollar yen trades relatively freely. Now, of course, we've had intervention, episodic, over the last several years, but by and large, the dollar yen does fluctuate with a lot more volatility than many Asian currencies, which are much more tightly managed. So I do think, indeed, with a broad upside pressure in the dollar across the board against Asian currencies, that will have an impact on the yen. But it's also worth mentioning that the yen does trade somewhat with a different dynamics than most other Asian currencies.
Right. And of course, for all Asian currencies next year, I think it's going to be about the U.S. trade, fiscal policy, that kind of dynamic and impact on the greenback. Alvin Tan, thanks so much for coming in, weighing in, sharing your insights and outlook for next year. Alvin Tan of RBC Capital Markets, and we're counting down as well to the start of China trade. Plenty more ahead. This is Bloomberg.
The US Treasury says it's been hacked by Chinese state-sponsored actor through a third-party software vendor. It's the latest in a recent string of breaches that have affected US telco systems. Let's get the details with Bloomberg editor John Harney in Washington. And John, thanks very much for staying for us. Want to sort of situate this in, as we just mentioned there, what has sort of been a larger campaign of cyber espionage from China. What exactly has happened here, and is it related to the recent string of attacks that we've seen?
Well, to answer the second question first, we don't know. Just that these are apparently the work of operatives who are connected to the Chinese government or Chinese security services, according to reports and allegations. This involves the Treasury. Apparently, the breach occurred through a third-party provider of software. The people who did this gained access to Treasury workstations, and according to the Treasury, certain unclassified documents. The company says that it is cooperating with the investigation and has informed customers, didn't say who they were, and that they were being offered support. So that's pretty much what we know up to now. But this cybersecurity regarding China, an adversary, will certainly be toward the top of the lengthy China agenda of the Trump administration.
Yeah, I was just going to ask John, how will this figure into the equation for the incoming administration, you think?
Well, there are many issues. You take your pick. Like regarding TikTok, Donald Trump was, thinks now that TikTok should be allowed to continue functioning as it has been, even though a law, according to a law that is about to take effect, the company is being forced to either sell or withdraw from the United States market. And then, of course, there's still Taiwan and the fentanyl traffic that has devastated so many families and communities in this country. And all of this, it's a huge relationship, but an adversarial one. At the same time, both countries, at least in the latter end of the Biden administration, and President Xi seem to be trying to forge some sort of accord, a way of getting along. But this hack doesn't help, obviously.
Just the latest incident in a number of sticking points between the US and China. John, thank you so much for sharing this context and reporting for us. Bloomberg editor John Harney in Washington. And as we keep an eye on US-China relations, we're watching as well for China PMIs that are out in a couple of minutes. In the meantime, seeing the early goings, quite a soft picture as far as stocks are concerned. Belle?
Yeah, looking a little bit soft there, but actually when you take a look at what we've had throughout 2024, and particularly really since September, it has been a relatively optimistic year for Chinese equities. You're looking at the best year for the HSI, for instance, going back to 2017, HSCEI 2009. I mean, sort of some optimism, I guess, from some traders who were expecting further monetary and fiscal support in the year ahead. It seems like maybe we've got to wait till the MPC for more details. What we're also tracking today in the session is analyst actions. One to note in particular is Xinyi Solar. It's had its price target cut at Citi on lower solar sales. We do see intense competition in that group. So the price target has been cut to $3.10. That's Hong Kong dollars. It had been at $3.60 instead.
Yep. Those are the kind of stocks that we're watching for the rest of today. We'll have the market opens in just a bit. You're watching The China Show. Welcome back. You're watching The China Show, and we're counting down to the open of markets. And of course, today, in the next couple of minutes, actually, we're hoping to see those China PMIs and set to show a bit of a tick down on the official manufacturing front, but a bit of firmness on the non-manufacturing PMIs. And this is all against the backdrop of weather. We see a bit of front loading as far as exports are concerned ahead of the Trump presidency, and weather stimulus is working its way through the economy, right, Belle?
Yeah, that's right. I mean, we'd already seen perhaps a little bit of front loading coming in, at least on the private PMI readings. And certainly we haven't really seen that full effect of stimulus taking hold just yet. But those numbers are due in just a couple of minutes or even shorter period. But today in the session, we're seeing fairly weak, really, to start the day. We've got the CSI 300 a little bit under pressure so far. And if you take sort of what's happening in broader Asian equities as a guide, we should end the year on a bit of a weaker note. But still, when you think about how Chinese equities have traded so far over the past few months, we're actually looking at some of the gauges. For instance, the HSCEI seeing its best year going all the way back to 2009. But we've actually got those PMI figures out just now, Avril. So what are you seeing?
Yeah, it's a bit lower than anticipated. We were expecting a number of 50.2. So a bit softer, still expansion territory. It's coming at 50.1, and this is a slower pace than the prior month. That's on the manufacturing PMIs. On non-manufacturing, we're seeing a firmer than expected print or a much higher expansion. We were expecting in the area of 50.2. This non-manufacturing, I think, might be the highest that we've seen since March. Maybe part of this stimulus working its way. 52.2, that's the print that we're seeing for December on non-manufacturing PMIs. We were expecting the travel, construction related activity to sort of boost things on the non-manufacturing front. Still digesting the numbers to get a clearer sense of what exactly is prompting this sort of upside surprise that we're seeing in the non-manufacturing PMIs in China. But 50.1 we're seeing on the manufacturing. Belle?
Yeah, in terms of the market reaction, I mean, we just saw the CSI 300 actually turning into positive territory just. It had opened about 0.25% to the downside. But let's take a look at also what's happening in Hong Kong so far in the session, given that we are also just thinking about where we're really sitting as we end the year here with these gauges hitting sort of their best performance that we've seen in a number of years, coming down to that expectation, as we've been saying, of further support from the fiscal and the monetary side for next year. So Hong Kong, you are seeing the Hang Seng gauge there up around 0.25%. Hang Seng Tech fairly flat, but again, it tracks what we had on Wall Street overnight. Let's get the reaction now. Bring in Zhou, he's chief economist at Guotai Junan International Holdings. And what's your reading so far? It seems like at least on the non-manufacturing side, there's a bit of positivity coming through.
Thank you for having me here, and a Happy New Year to both of you. I think, looks like at least the manufacturing sector still relatively weak. Actually, if you look at the seasonality in the past few years, the manufacturing PMI normally relatively weak in December. So I think, this is kind of in line with my expectations. But what really surprised me is the non-manufacturing PMI, which picked up quite significantly in this month. I think, if you travel around in China, really, the restaurants get more and more crowded. And if you look at the property sectors, especially in Shanghai, it looks like, the transactions has also been improving. So I think, maybe we have seen some green shoots for now. But of course, for the coming year, the problem or the challenges are still ahead of us. I think, Trump's administration, as well as, whether the sustainability of the Chinese physical stimulus will be working, will be the biggest question marks, for investors when we talk to them in the past few months. And if you look at the market for now, I think, the dollar will be a problem for China as well, because, looks like, dollar will be still strengthening given Trump's all kind of measures. And this will kind of bring in pressures, depreciation pressures for Chinese yuan as well. But at least for now, today's data at least shows that, the economy still on the track to a relatively improving outlook. Of course, we are still have to embrace more kind of headwinds ahead of us.
So do you think that this, particularly the non-manufacturing reading, do you think it's actually a signal that consumer confidence is starting to pick up? And do you think that's perhaps also a sign that stimulus is starting to take hold?
Well, I think, I have to say that, there might be some kind of improvement in the consumption for now. This is actually, we can see from the high frequency data. But if you ask investors, around of us, basically they're still concerned about, whether this kind of improvement will be sustained, and whether China's physical stimulus will be big enough next year. And we know that, the numbers will be only out in next March. And before that, the market will continue to guess. And in this case, I think, I have to say the market will be probably in a relatively flat rate in the short term, in the foreseeable future. And the market will definitely, take a relatively cautious mode and watch to see whether this kind of policy and data will be improving together, or if the data is not good, whether the policy will catch up. So I think, that's kind of a game will continue in the foreseeable future.
Up until now, we've been seeing how exports more or less have been supporting the Chinese economy. But of course, about next year, we don't yet know the sort of tariffs that will be put in place and, what Trump's policies might hold. What do you think are the key headwinds then for the Chinese export picture?
Well, I think, two things here. One is that, of course, looks like, Trump's tariff will be a real issue. It's not like a threat. Because, in Trump's the first kind of term, where every time he talked about the tariff, people say, okay, this is just bluffing. And now I think, looks like, the tariffs, 60% tariffs on Chinese goods will be there. And in the meantime, I think, the problem is that, Trump also imposed tariffs on other kind of countries like at least a threat to Mexico and other kind of China-related kind of supply chains. I think that will be another issue. And of course, China can hedge against these kind of headwinds if they can devalue the currency a little bit. But also you can see that, at 7.3, dollar CNY face kind of resistance here as well. I think, it's also a problem for the Chinese policymakers to decide whether, devaluation will really help the exports or that might, trigger more kind of retaliation from the U.S. I think all these kind of things will be the focus or the keyword will be Trump, his policy and his kind of measures will be the key challenges for the Chinese exports in the coming year.
What are some of the other dynamics that you think Chinese policymakers are watching? I mean, key to perhaps the Chinese stock market support that they're trying to engineer, they have to, at the same time, keep the currency stable. What do you think the thinking for policymakers is at this point?
I think, one thing is that, of course, at the end of the day, domestic demand will be the only kind of solution for China to really kind of hedge against all these kind of external headwinds. I think that's the key part of the policy package. And of course, the other thing is that, of overall kind of geopolitical issue and cybersecurity issues will be the kind of, or national security issues will be the Chinese policymakers to focus or to monitor as well. So I think, this kind of, a lot of kind of moving parts if you look at overall Chinese policy framework. So in this case, basically we have to still say that, uncertainties will be probably, relatively certain for us to think about the policies kind of a toolkit in China. But overall speaking, I think, the cornerstone will be domestic market, domestic demand, and the security will be another kind of a keyword when we look at overall China's policies in the future.
Yeah, many moving parts for Chinese policymakers. Stick around. We want to get more of your thoughts. Zhou, for now, chief economist at Guotai, Junan International, sticking around. Playing more ahead, this is Bloomberg. You're watching the China Show, and of course, we've been getting those numbers on Chinese PMI in the past 10 minutes that stronger than expected reading on the non-manufacturing PMI, I think. Not expected by economists, and certainly a bit of a bright spot, it seems, for the services, perhaps the construction side of things. And dollar China is moving lower as we speak. Let's bring in Zhou, again, chief economist at Guotai Junan International Holdings. So earlier we were talking about, is this a sign of consumer confidence coming back to the economy? Apart from the consumer equation side of the equation and the kind of business confidence as well that we want to see, what do you think is the best way to kind of boost this that policymakers should be exploring?
Well, I think, if you look at the overall kind of business in China, of course, if the stock market tells you that, the market actually relatively confident that, the state-owned sector will be relatively performing well. So if you look at the bank stocks, they are keeping kind of hit record highs. And despite that, a lot of stocks, they are still relatively weak for now. I think, generally speaking, when we look at kind of core business core kind of part of the Chinese economy, I think state OEs will be still the important or critical kind of cornerstone for the economy. So I think, overall speaking, for other sectors, especially the private sector, I think, they still need some more time to really see their kind of capex to come back. But at least, some TMT companies, their stock prices are not doing badly this year. I think, overall speaking, the problem or the concern still on the lower tier cities and the lower tier kind of private firms. I think, I'll have to still wait to see. And at least, China has kind of passed some laws recently, try to boost the business sentiment among the private sectors or private firms. I think, we still have to be relatively patient. But of course, for now, the market is also relatively kind of cautious on this part.
Yeah, it seems like investors and businesses perhaps are still waiting for greater clues on what we can expect on the fiscal and the monetary front. Do you think that we need to wait until the MPC in March for that, or do you think we'll get more clarity before then?
Of course, I think the answer is very clear. We will get more clarity before that, because we will see the data before the MPC. The MPC will give you the exact numbers or exact target, but the target itself does not translate. If does not translate into the real economic activities, investors will run away. So basically, in this case, of course, you know that the policy will be there, but on the other hand, we have to say that the real activities, high frequency data will give you the relatively clear picture, and we will get kind of clarity before the MPC. The MPC might be a kind of a milestone for the policy, but it's not the kind of cutoff point of the economy. I think real economic activities will be still the focus for investors to watch.
So in terms of stimulus announcements, what exactly can we realistically expect that might be announced in March?
Well, I think we know that there's different kind of perspective on that, but of course one thing is clear. The government, the central government, will take, the relatively big leveraging part in Chinese economy. Not only this year, I think this will happen in the next few years or even next decade as well. Given that, Chinese households, they're kind of deleveraging, I think, the policy side will be playing much more important role in the future. So I think that physical kind of spending and also the issuance of the government bonds will be the focus for us to watch when we track China's overall kind of policy package.
Two questions here. Firstly, when do you think we'll see a RRR cut? We had sort of seen expectations maybe by the end of the year. Of course, that seems unlikely now, but perhaps in the early part of 2025. And then also, what are you thinking around the budget deficit target for next year as well?
Well, I think, I also hear two voices. One is that the physical deficit target will be around 4%. And someone said that, it's much more, will be 3.5%. So I think we have to wait. And the other thing is that, when we look at overall kind of physical spending, one is the official physical kind of deficit, and the other is that we know that China has a lot of kind of local government spending and SOE spending. They also can be regarded as the kind of broad kind of physical spending as well. So that part I think will be still kind of expanding and will be still expanding in the future. So I think the actual the exact numbers might tell you that the official target will be higher or lower, but overall spending will be still relatively aggressive in China in the next couple of years.
That was Zhou there, Chief Economist at Guotai Junan International Holdings. And here are some of the big corporate stories that we're tracking this morning as well. Well, as the year draws to a close, we've seen a flurry of IPO filings in Hong Kong for early 2025. Yibin Bank is seeking up to $245 million, with trading set to begin January 13. Other firms that are joining the year-end listing frenzy include WeDoctor, Brain Aurora and Conti Ocean. 2024 was the best year for Hong Kong's IPO IPO market since 2022 in terms of total volume. India's Adani Group is getting out of its consumer joint venture, Adani Wilmar, in a $2 billion multi-phase deal. An exchange filing shows Adani Enterprises will sell its 44% holding in stages to Singapore's Wilmar International. Adani plans to use the proceeds to bolster its core infrastructure business, including air transport and renewable energy. Separately, the CEO of Adani Green Energy, Amit Singh, will step down at the end of March to assume a new leadership role within the conglomerate. Singh will be replaced by Ashish Khanna, who currently leads the group's internal or international energy business. The change comes as the company faces US allegations of offering bribes to get power contracts. We'll have more on the Adani Group in the next hour, so stay tuned for that as well. But if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. You can also join the conversation by sending instant messages to our guests and to our team during our live program. You can check it out at TV Go. We'll have plenty more ahead. This is Bloomberg.
Welcome back. You're watching The China Show. As we look back at the year 2024, it's really been a story of U.S. exceptionalism and the economic resilience. Investment management firm New Century Advisors is warning, though, that traders and the Fed can't take U.S. labor market resilience for granted. Chief economist Claudia Sam told us more about potential blind spots for the economy in 2025.
If we could keep it as it is right now, largely, this would be another great year ahead of us. You know, we've been surprised at how well the past 2 years have gone, particularly when you think about growth and how the consumers have held up. But that doesn't have to keep going. So what we really want people to focus on are the blind spots, right? What could go wrong? Who isn't getting enough attention? And I think one area, you know, if I had to maybe point some Fed officials to a blind spot, I think, you know, they showed a lot of complacency in their last summary of economic projections on how well the labor market would continue to hold up. You know, what we saw them kind of write down, the typical official, was something that basically has the unemployment rate sticking about where it is right now for the next 3 years. That's a pretty remarkable and frankly would be very unusual path to the labor market. And yet there was all kinds of concerns about inflation and the uncertainty around inflation. But I think I'm still concerned that there are things in the labor market, while good, don't quite look like sustainable. And that's where the problems can come in, and so that's one area that I think is still worth watching.
So if I ask which is a bigger risk, a weakening labor market or a stubborn inflation, you're going with the former rather than the latter.
Inflation's fine right now. I mean, we are really not that far from 2%, and we've seen a lot of encouraging signs under the hood that we are getting to this last mile on inflation.
But right now,
the labor
that's
market
before tariffs. That's before we deport millions of workers. That's before Donald Trump comes into office. So things could change drastically after January 20th.
Absolutely. They could change drastically. And I think it's appropriate that we have had a very deep conversation about the policies that have been put on the table. And there have been a lot of policies put on the table. And it's really important to have this conversation and talk about some of their potential pitfalls. And maybe we won't see all of them put into place. And that probably would be a good thing for the economy. And yet, you know, kind of taking for granted the good stuff that we've got going in the economy that's a little more nuts and bolts, like the labor market functioning, and just saying, oh, well, that'll just keep going. That's all fine. It's in a good place. I think that's that could be a real mistake in terms of, because the labor market in particular is always and has been the past few years such a linchpin to this amazing period of a big disinflation, growth has stayed strong, and unemployment has stayed relatively low. You know, and that's something we want to keep going.
That was New Century Advisors Chief Economist Claudia Sam speaking with our colleague Matt Miller there, and taking a look at the market action so far, because we've actually seen the CSI 300 reversing its earlier gains, but one of the bright spots that we have so far in mainland equities today are data companies. What's driving that is a report out that essentially we have China's government that's aiming for over 15% annual growth growth rate of over 15% for the data industry. Thinking about how that's conceptualized in China. So you're talking about sort of the application of data technology to develop products and services, and it's quite a broad form that sparks or covers a range of digital activities: data collection, storage, processing. But essentially, China's trying to grow this industry at quite a significant rate. So you're seeing that growth there, or that boost that we're getting to some of those linked stocks. Broadly, though, as I said, we are seeing Chinese equities looking so far at least a little bit mixed, if not under pressure in the session today. We had the PMI figures out earlier, and actually we saw some strong growth in the non-manufacturing side. The manufacturing side slipped a little bit to 50.1. The estimate had been for 50.2. Where we did see better numbers was in the non-manufacturing sector, rising to 52.2. The survey had been for 50.2, Avril.
Indeed. Coming up in the next hour, Societe Generale gives us their Asia equities outlook as we head into 2025 and why they think Chinese markets face fresh volatility ahead.
Welcome back to the China Show. Taking a look at the CSI 300, it's the last trading day for 2024. We've got fairly fluctuated trading so far, going between gains and losses. You see that initial spike there, and that was after we had the PMI readings coming out. We saw services looking particularly strong, even the manufacturing side that was above 50 for a third straight month, but it's still not enough for these markets. Maybe they're still on the outlook or looking for further easing from the PBOC, Avril.
Yeah, I think that theme of not enough is being reflected on the Chinese currency as well. Despite some of those initial gains, we're seeing it mostly giving that up. And you think about how earlier today, despite a much stronger than expected fix on the yuan, about 1,200 pips stronger than traders estimated, we're still seeing earlier how the yuan barely budged. It was at 731 levels on dollar China. So really the sense you get of how more easing support for the economy is needed to show a more convincing turnaround. So the yuan erasing those earlier gains as well. Belle.
All right, let's get more on these PMI figures. Bring in our China correspondent, Min Min Lo in Hong Kong. And Min Min, what stood out to you from the data?
Well, of course, is that non-manufacturing PMI, the big beat that we saw there, 52.2. That's the strongest print we have seen since March. And non-manufacturing covers both services and construction. Both of these sub-gauges improved in December, but it's really construction that is most pronounced. The gauge there coming in at 53.2, up sharply from a contraction of 49.7 the previous month. So this perhaps reflects a bit of recovery in the property sector, but also partly because of those infrastructure-related fiscal spending. We know the government has been urging local governments to speed up spending towards the end of the year. And if you look at the manufacturing PMI, still some softness there coming in at 50.1. If you break down the numbers, look at the sub-indices there, output prices, for example, contracting to 46.7 versus 47.7 the previous month. What this shows you is there is still that overcapacity in the sector. And again, the employment gauge as well coming in at 48.1. For non-manufacturing, it's actually hovering around 45. And that shows you the pessimism around hiring by these businesses really doesn't bode well for people's prospect around income growth and employment prospects. So again, is that persistent story of weakness in the domestic demand that is partially offset by the resilience of overseas demand here.
Indeed, this is an economy that is in need of support. Min Min, the attention sort of shifts to President Xi, who'll be giving the New Year speech later tonight. What will traders be paying attention to?
I'm not sure if traders will be glued to their screens this evening at 7 p.m. This is a regular speech by President Xi. Every year he would wrap up the year, really talk about some of the achievements as well as the challenges that China has confronted over the past year. He's likely to give quite a positive report card for China because this is meant to be a sort of inspirational speech where he gets to connect with his domestic audience. He might highlight some of the breakthroughs China has made this year, especially when it comes to science and tech, space, innovation. He will likely highlight the government's priority in continuing to address issues related to social welfare and people's livelihoods. He will touch a little bit about China's foreign policy, about some of the marks China has made in international affairs this year, and also set the tone for the new year, where he will likely try to give his audience some confidence about the economic recovery next year. But again, don't hold your breath for any sort of market-moving information tonight.
All right, we won't be holding our breath, Min, but something that he could highlight, again, maybe it won't come up, but something that has been a positive is the performance we've seen for China stocks over 2024, really, of course, led by these expectations around easing on the monetary front and also further support from the fiscal side. But I think we've got a graphic we can show taking a look at the HSCEI, for instance, the China gauge in Hong Kong, best year since 2009. What's the outlook as we head into 2025, and can we expect to see Chinese equities continue to move a little bit higher?
Yeah, really, for all the talk about how slow the Chinese economy is, if you just look at how the markets had done this year, they really outperform the broader Asian benchmark. And it's really because of that September stimulus-induced rally, even though stocks had really given up a lot of the gains in September, but they are still performing very well going back to, 2020, 2017. And next year, we have heard again and again the government pledging more support for the economy. We are likely to see an increase in the fiscal budget to deficit ratio, which suggests more public spending from the Chinese government, both at the central government level and the local government level, because we already had the announcement about that 10 trillion yuan in fiscal stimulus to increase the debt limit for local governments. And of course, the pledges to stop the decline in the property sector and to bolster private consumption, which will really take center stage this year, given the urgency, given that President Trump is coming into office next year and the threat of those protectionist tendencies from the US and Europe. So we're going to watch those consumer staple stock very closely. Financials have been doing really, really well this year. That's really because of the record high dividend payouts, partly because of those reforms in the capital market. So we are expecting another bumper crop of interim dividend in the first quarter of next year for the financials as well. And again, those themes related to self-reliance, the tech names, semiconductors, those had seen really stellar performance this year. We continue to expect very good growth on those fronts as well.
So many sectors we're keeping an eye on. Thanks so much, Min. China correspondent Min Lo for us there. And of course, as Min had been alluding to, really in the spotlight, US-China relations, our other top story today, the US Treasury says it's been hacked by a Chinese state-sponsored actor through a third-party software vendor. It's the latest in a recent string of breaches that have affected US telecommunication systems. Let's get the details with Bloomberg editor John Harney in Washington. John, again, thanks so much for staying up and, providing the context for us on this. But talk to us about the nuances. This is the latest incident in a string of similar breaches.
That's right. This according to a letter sent by the Treasury to to Congress. It was reported earlier this month on December 8th. And it involved access by these Chinese operatives. There are these Chinese operatives who were able to get information from several workstations at the Treasury, and to also access unclassified documents. The Treasury added that this threat is no longer active, And obviously, the investigation is continuing. The company said it's cooperating with the investigation. As in the broader picture here, the U.S.-China relations, which cover a vast scope of issues and agendas, et cetera, had seemed to have been improving somewhat. But this, as the Trump administration is about to take office, suggests that much remains to be resolved.
John, we'll have to leave that there, unfortunately. That was Bloomberg editor John Harney there in Washington. And if you want more on that story, it is actually one of the top read today, of course. You can get a roundup of it and anything else that you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to Daybigo on their terminals. It's also available on mobile. In the Bloomberg Anywhere app, you can customize the settings so you only get news on the industries and the assets that you care about. But that story, as you said, Avril, first thing you need to know in today's edition of Daybreak.
Yeah, and our other top story as well, Belle, we've really been talking about those China PMI numbers, haven't we? Up next on the China show, we'll speak to Societe Generale about their stocks outlook for next year, why they think that these Chinese markets face fresh volatility ahead. So much to rake through, not just out of the Chinese markets. We're going to get the outlook for the rest of Asia as well. Stay tuned for that. This is Bloomberg.
Taking a look at the PMI figures, this has really been the highlight of the session so far today. We're seeing the Hang Seng here moving a little bit higher off the back, but essentially the PMI figures came out, and if there's really something to highlight here, it's that you're seeing that services gauge expanding or lifting to 52.2, so far above the estimate of 50.2 instead. Manufacturing, it was a little bit of a slip down to 50.1, again weaker than the survey estimate, but still we are above 50 for a third straight month. Taking a look at really what we're getting across the course of bonds over this year, I mean, we're looking at what's going to be the best year going back to 2021, but certainly what we've seen expressed so far in yields has been this expectation for further monetary policy easing. And even this week, for instance, we had local media reporting in China that the governor of the PBOC, Pan, was saying that we could see a triple R cut really imminently, perhaps not by the end of 2024, but certainly in the near in the near term in 2025. Stocks wise as well, you have seen again that expectation for further supportive measures from policymakers in China playing out. The HSCEI, for instance, looking at the best year going back to 2009. But let's bring in Frank Benzimra, head of Asia Equity Strategy at Societe Generale. And Frank, I mean, you're fairly, I don't know if bullish is the right word, but you certainly seem to be quite optimistic on where Chinese equities go next year.
Yes, so we are looking at two things when it comes to China. The first one is the earnings, and the second one is policy. And what we are starting to see when it comes to the Chinese earnings is about the last 2 quarters, we observe some stabilization. It's not that the earnings season is good, it's still very difficult, but compared to the expectation, we see some convergence between the reality and the expectation. And this is one positive element. And the second one, which has been really the reason why we've been overweight on the Japanese equity, has been the policy and some course correction that we are seeing to stabilize the economy. So now, as you are showing in the two screens, we are in a quite unusual situation where we have both the bond market and the equity, which have been performing very well. And we could see in 2025 some divergence between in the direction of the two markets. So that I think will be one of the interesting elements on this market.
Yeah, so explain that in greater detail, that divergence you're seeing between bonds and equities going into the new year in China. What do you think is going to be the big driver of that, and then what are you seeing exactly?
Yes, so what we are seeing in China has been some policy which has been supportive both of equity and bonds. And when we look at the collapse in the yield in the recent period and the more sign that the monetary policy is going to loosen, that's something that I think will continue to support the equity market. And then we are seeing some deflationary pressure. That's not something which is new. And as long as we are seeing this deflationary pressure, we could see the bond market also to perform well. And my take actually on 2025 is that we could see the equity market to outperform the bond market, given the level of valuation where the two markets are at the moment.
And talk to us more about your expectations for stocks in particular. What are your sort of expectations around what sort of jump we see from here into the end of 2025? And are there any sectors that you're favouring in particular?
Yes, so a couple of things. Number one, we think that the onshore market is going to outperform the offshore market. The onshore market has been very much one of the priority of the policymaker and the one of the support for the policymaker. Number two, I would expect to see industrial cyclicals, the one on which we see some market share improving, some operating margin improving, to continue to do well as well. And so this would be really the two parts of the market that I would be quite positive. Now we know that there are some massive challenge on the equity market. So I was talking of the deflationary pressure. We can think of what the impact of the forthcoming tariff are going to be as well on the market. So certainly we could see some volatility, especially in the first quarter of the year. But taking a broader view, looking at the next 12 months and the trajectory of earnings, I think it could be another good year for the Chinese equity market.
Yeah, talk to us about what you see in terms of the tariff risk, because I think we don't always distinguish between Trump in 2016 versus Trump going back into the White House this time, because the Chinese reliance on the US now looks quite a lot different, and there's been a diversification of supply chains already, and we've seen China also getting new trade partners as well, or increasing its trade relationships with other countries. What is your sort of assessment of the level of impact that these extra levies could have? Yes.
First of all, in terms of the timing, this time it could come quicker than in 2016, because actually in 2016 it's really from May 2018, when we have the first tranche of $50 billion tariff, that we could see the direct impact on the Chinese economy and on the equity market. So this time it could come earlier. Now, one of the big questions is what is going to be whether we are going to have 60% tariff in one shot, whether and we think that's quite unlikely, but it could be more in a gradual way. And what is going to be the response, especially the response from the currency market and from the yuan. So that's and I think that's going to be the first line of defense. So we could see further pressure on the yuan versus the dollar, but we are not expecting to see all the pre-announced tariff to happen immediately. And I think that's going to be an important element for the equity market. But certainly, we are avoiding a number of exporters, and we give on the first quarter of the year a more cautious message.
A South Korean court has issued an arrest warrant for President Yoon. That's after the impeached leader repeatedly defied investigators' requests to face questions over his martial law declaration earlier this month. Our senior editor, Bill Ferries, is with us now for more. And Bill, just bring us up to speed here. Is this something that President Yoon needs to respond to?
Well, yeah, the court order is definitely an escalation in this fight over whether he needs to face investigators and take questions over that 6-hour declaration of martial law. It really raises the stakes here in what's become a constitutional crisis for South Korea, which is now effectively on its third leader this month, with acting President Choi, who is also the finance minister, acting as the head of state effectively at this point.
So what's sort of the outlook here? I mean, we've seen a number of leaders being impeached now. Do we get any sort of stability in the near term at all?
Well, it does seem like the plane crash is perhaps causing a little bit of a pause in some of the political fighting, but it's going to resume probably within days, if not sooner. The two big things to look for on the agenda ahead are this continuing fight over the country's top court and whether the opposition can get 3 members named to the 9-member court. There are 3 vacancies currently. Opposition would like to get 3 new judges onto that court. That would probably aid their efforts to have President Yoon removed from office. But there's a fight going on with that, and it could drag out into the spring or perhaps even the early summer. President Yoon is removed from his official capacity, but he's saying that his declaration of martial law was within the scope of his powers and that he should remain in office. That's going to be the longer-term fight. The shorter-term fight will be over getting these judges onto the country's top court.
Okay, so that's sort of the political side and the judicial side, but what about also the impact that the Jeju air crash on the weekend is having? Because, of course, I mean, huge loss of life, the worst air accident we've seen in Korean history. Is that having any sort of bearing on the political climate as well?
Yeah, I think it is causing a little bit of a political truce in South Korea right now. You had acting President Choi visiting the disaster area. There's, of course, an emergency commission looking into what happened, what went wrong in this case, and what can be done better in the future. That's also something, I mean, there are concerns about how much acting President Choi can manage on his plate at one time. He's acting the head of South Korea. He's still the finance minister at a time when the economy is starting to suffer from a lack of confidence, inflation higher than forecast, the won, the weakest currency, major currency in the world this month. And he's also officially heading, overseeing this investigation into the air crash. So the crash is causing a little bit of a pause in that fight, but I don't expect that to last very long because there are these continuing battles over the judges on the top court and ultimately whether President Yoon will be able to return to office or not.
As Bloomberg's Bill Ferries there from Singapore, thanks so much for joining us. And taking a look at some of the big corporate stories we're tracking this morning as well. India's Adani Group is getting out of its consumer joint venture, Adani Wilmar, in a $2 billion multi-phase deal. An exchange filing shows Adani Enterprises will sell its 44% holding in stages to Singapore's Wilmar International. Adani plans to use the proceeds to bolster its core infrastructure business, including air transport and renewable energy. Separately, the CEO of Adani Green Energy, Amit Singh, will step down at the end of March to assume a new leadership role within the conglomerate. Singh will be replaced by Ashish Khanna, who currently leads the group's international energy business. The change comes as the company faces US allegations of offering bribes to get power contracts. We have more on the Adani Group later this hour. And taking a look at how markets are faring so far in the session, of course, it is the last trading day for 2024. We've had thin liquidity, of course. A lot of traders are offline today in the session. A lot of key markets are as well shut. The Hang Seng and the CSI 300 are moving in opposite directions this morning. But really the key headline has been the PMI figures being dropped. Manufacturing, we saw a bit of weakness or a bit of an easing from 52.2 to 50.1. The services side, though, a pickup to 52.2. In terms of the reaction to that, we're taking a quick check on consumer stocks in China this morning so far as well. These are gaining higher. Again, it was that services side that saw the big pickup. Are we starting to see consumer sentiment lifting and also responding to those stimulus measures? The other thing to note as well is what's happening in the IPO market in Hong Kong. We've seen a flurry of filings to the Hong Kong Exchange overnight. Listings in the pipeline for 2025, they include WeDoctor, that's backed by Tencent. But essentially, we're seeing the best year in 2024 for the market for IPOs in Hong Kong in 2 years. That's in terms of total volume. So I'll have more details on that ahead. This is Bloomberg. Welcome back to the China Show, taking a look at a live shot of Tokyo. Here we have Japanese markets that are shut today already for the end of the new year or New Year holiday, but it is the Nikkei keeping an eye on how futures are faring. I mean, we're guiding for a weaker start. Maybe it's the Nissan story that plays into that, given we saw a huge drop in Nissan ADRs as well. But what is interesting to note is that the Nikkei 225 has been one of the best performing markets in 2024, and actually it managed to hit a record high. This is a graph here taking a look at all the other markets again that have hit record highs. The Nasdaq, of course, stands out. That tech theme very strong, that also played into what we saw in the TAIEX, for instance, another very AI exposed market. Bitcoin, Mag 7, of course, as well playing into that. Bitcoin, a story really of President Trump coming back into the White House and these expectations that we're going to see more pro-crypto policies in place. That's some of the assets there, as you said, that hit record highs in 2024. Taking a look at broader Asia benchmarks now, ex-Japan again, because we said the market is shut today for a public holiday, as are markets, including Korea, for instance. Australia will be closing as well around now. But we do see stocks a little bit under pressure so far for a second straight session. US futures, again, fairly steady so far, very thin liquidity in play, keeping a very close watch on the dollar gauge as well, given we've still got that expectation for King Dollar to remain. Let's bring back Frank Benzimra. He's head of Asia Equity Strategy at Societe Generale. And Frank, I think one of the key questions for investors, given we've seen such US exceptionalism in 2024, does that remain intact into 2025?
Yes, that's you're right, and that's going to be the key question on the global market. Very practically, we are going to look at what's going on the interest rate, what the Fed is going to do, and that's going to be quite crucial not only for the bond market but also for the equity market, because we are coming at a stage where the risk premium is becoming pretty compressed. And on our own model, we are coming close to 3%. And at this level, we could see some concern on the equity market. And so we would really need to see a lot of upward revision to push the market if we have interest rates, the 10-year rising. And at the moment, we are at 4.5 on the 10 years, but going to 5% and above 5% would create some doubt about the equity market and this part of the US exceptionalism. And the other part is, of course, the dollar, with another good year on the dollar index. And I think this is also going to be one key element shaping the global market, and especially in Asia.
Yeah, and actually, Frank, I think we've got a chart here taking a look at just how much investors have changed their thinking around Fed easing, because we came into 2024 thinking we'd see 7 Fed rate cuts, and of course that's been significantly dialed back, and you can see it expressed there. So if that sort of puts a pressure, that higher for longer, if you see higher Treasury yields off the back, you've got concerns around Trump policies, whether they're reflationary, and then at the same time, you've got this AI theme, and that has been where investors have really put a lot of money into. Do you see AI still being a dominant trend for the next 12 months, or do you think we start to see maybe other parts of the market becoming more favourable, given valuations as well? It's just so pricey right now.
Yeah, so when it comes to AI, so you have, of course, the valuation, and you have the earnings, and how upside surprise you can have on the earnings, and what we've been advocating on when it comes to AI and the U.S. equity market and the global equity market, for that matter, is to broaden. And so, for instance, one of the trades that we have for 2025 is to have a long position on the equal weight of the S&P 500 to capture other part, the more cyclical part of the equity market, where we could see some positive surprise. So that's very much a part of the US exceptionalism, actually, and that's something that we see mostly in the US, and I think broadening and diversifying should be one thing that we should look in the coming year.
So diversification, we've seen Japan, for instance, being one of the key markets this year. Do you think that trend also stays?
No, I don't think so. And the Japanese market has been quite interesting, because it has very much increased in the first quarter of the year, and then after reaching 40,000, it has been more or less flat over the last 9 months. You have two really big engines for the bull market in Japan. One is governance and the change that we are seeing at the micro level, and the second one is the weakness of the yen. But we are reaching a level where the weakness of the yen is becoming an issue for the economy, is becoming an issue for the market, and you have this big anomaly today in the global market, which is the valuation of the yen. And so it doesn't mean that we have to be negative on the equity market, but we need to be more selective, and we need to to have the good currency hedging policy, and also to be more on the domestic part of the market, where we see both valuation and earnings being more attractive than the export part.
So I'm interested then, when you see the opportunity for diversification. I mean, China's one that's been noted, but I see in your notes as well, you're saying for India, for instance, you think more patience is needed. Yes,
because we've seen the market made some peak during the summer. We had a bit of a correction, a bit of an outflow, and we start to see the valuation coming down, but just a little bit. And what we are seeing, really from a fundamental point of view today on the Indian equity market, is that it's one of the most expensive markets with the US. Now you are going to pay more than 20 times the earnings, and at the same time you have this moderation in the earnings. And 2023 was a very, very good year, and then we have some downgrade in 2024, especially in the second part of 2024. The economic story remains quite attractive, but what we are paying for the market today is still a little bit high. So we would like to see a little bit more correction before getting back into that market.
All right, Frank, thanks very much for joining us on the last trading day of 2024. And of course, we'll see you back with us again in 2025. That was Frank Benzimra, the head of Asia Equity Strategy at Societe Generale. And as we said, Asian equities, they are ex-Japan, of course, today because we've already got Japan closed for the public holiday. But we are under a little bit of pressure so far today, sliding for a second straight session across the board. US futures there looking fairly steady so far, and we're seeing a bit of a pop for the Hang Seng. PMI figures, of course, playing into that in China. Well, recapping what is the latest in the political turmoil in South Korea this morning, because we've got a response now from President Yoon's legal team. This is to an issue from a South Korean court, or the issued arrest warrant that came out earlier for the President Yoon Suk-yeol. He has been, of course, suspended from power over his short-lived martial law declaration. But essentially, the legal team representing President Yoon is saying that the arrest warrant, or that arrest warrant, is illegal, and they're also expressing regret over the arrest warrant also being issued. Now, if it is executed, Yoon will be the first president in South Korea's history to be arrested while still in office. But the investigation team are yet to decide when to execute the warrant, and it's also unclear if they're going to be able to take the president into custody. But the latest there, as we said, South Korea, the markets are shut today, but we certainly have seen them sliding in response to this political turmoil that's also even perhaps starting to play out into things like the inflation figures as well. But let's leave that there and shift to India, because the Adani Group is getting out of its consumer joint venture, Adani Wilmar, in a $2 billion multi-phased deal. Bloomberg's conglomerates reporter PR Sanjay has the details for us in Mumbai. And just bring us up to speed here. Why exactly does the group want to divest of this business?
The primary reason is the conglomerate, the port to power conglomerate, want to focus on core infrastructure business. So we spoke to the management representatives. What they're saying that if they are in the business, they want to be in top 3. So in this consumer business, either they want to be on top of it. For that, they need a lot of investment. But now currently their focus is to bolster their core infrastructure business. So they want to invest in this. And with this one, they will be exiting from the Mumbai listed Adani Wilmar Limited in a $2 billion multi-phase deal. And they will be raising $2 billion over in the 2 deals. One is like OFS, and another one is sale to Wilmar International. And as you rightly asked, they want to exit from this non-core business, and this whatever fund they're raising, it will be utilized to turbocharge the growth of Adani Enterprises Limited, which is a incubating arm or flagship arm for the Adani Enterprises, and they will be used in energy, utility, transport, logistics, and renewable business.
So thinking about the challenges that Adani is facing, bigger picture, I mean, we know that there's the legal challenges in the US, for instance, where federal prosecutors have alleged that Gautam Adani played a part in a bribery scheme, but this could have perhaps increased the financing costs for the group. Do you think that this also plays into the stake sale, or is it just simply they're just wanting to raise cash to put to other uses?
To be sure, this proposal was always there since 2022. So they were mulling to exit from this consumer joint venture, and they were in talks with 2 to 3 potential investors, strategic as well as financial investors. And then they were hit with the Hindenburg research, and the process got delayed. And when they were ready to hit the market, then Department of Justice made that allegations, which again delayed. So now with this kind of public announcement is kind of giving confidence that Wilmar has agreed to buy that stake, and there will be one more undisclosed investor. So meanwhile, they're fighting the case allegations. They are also now boldly saying that, making a confident statement that they are willing to exit from this, which means they must have got tied up investor to buy that 13% stake. And they reiterated that they will be raising this $2 billion, and they will be reinvesting in their core infrastructure businesses.
All right, that was Bloomberg's PR Sanjay there from Mumbai. And let's turn back to China's economy now. Last month, we asked the Minneapolis Fed President Neel Kashkari how the president-elect Donald Trump, his tariff threats, how they could affect global trade, and his view on Beijing's battle to revive its economy.
You know, there's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in. From our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy, and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path? You know, reinflating, so to speak, their housing bubble doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to, but I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 6-10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit. And countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
That was the Minneapolis Fed President Neel Kashkari speaking with Insight anchor Haslinda Amin last month. On the topic of China's economy, of course, we've had an update on how it's faring this morning in the latest PMI readings, taking a look at the 8-shares gauge today in Hong Kong, tracking up 0.7% to the upside, but really being boosted by the PMI figures because we saw the manufacturing gauge above 50 for a third straight month. So it does certainly really boost those estimates that we're going to reach the annual growth target this year. On the non-manufacturing side, the services side, this was really where we had most optimism being expressed because it rose to 52.2, so far above what economists had surveyed at 50.2 instead. And again, perhaps a signal that we're starting to see more consumer confidence returning, and this comes against a backdrop of policymakers pledging to forcefully boost consumption again next year. So a lot of expectations when we're going to see more fiscal measures to try and support that actually taking effect. The 8-share gauge, as we said, rising off the back of PMI figures earlier. Well, taking a look at what has been one of the biggest movers on Wall Street overnight. We also saw them slipping yesterday in the session in Tokyo, but shares of Japanese automakers Nissan and Honda in focus, not just their Japanese listings, the ADRs as well. This is the last close, of course, because Japanese markets are shut already for a public holiday. But essentially what's been really contributing to the drop, because over 2 days you're looking at a decline of 13% for Nissan, is this expectation around the tie-up with Honda and essentially what could be sort of the starting point for the share transfer ratio, which according to a Nikkei report is estimating at 5 to 1. So that does perhaps indicate that it's unfavourable to Nissan. We'll, of course, wait for further details of this to be made clear. But essentially, it does seem like investors are getting fairly disappointed, even though you had that initial optimism for Nissan in particular. So that is the market reaction that we're seeing, but we've also got perspective from the man who engineered Nissan's tie-up with Renault, and that he says the Japanese carmaker's new plan for a possible merger with Honda shows that it's in panic mode. We spoke with the former Nissan chairman Carlos Ghosn, who's been living in Lebanon since his dramatic escape from Japanese custody 5 years ago.
It's a desperate move. It's not a pragmatic deal because, frankly, the synergies between the two companies are difficult to find. There is practically no complementarity between the two companies. They are on the same markets. They have the same products. The brands are very, very similar. So in a certain way, from one side, Nissan, it's a desperate move to try to find the future. And from the other side, Honda, which, if I understand well, they were not very excited about this move. But, you know, you have to count with Meiji in Japan. That means the Meiji had a big say into it. So at the end of the day, they're trying to figure out something that could marry the short-term problems of Nissan and the long-term vision of Honda.
Do you think Nissan is being do you think Honda is being pushed into this deal by the economy ministry? There's politics pushing this deal, Carlos, rather than the value of the deal?
Without any doubt for me. That means having lived in Japan for so many years, I understand how influent can the Meiji be. And I can tell you that from all the data that I received about the performance of Nissan, which has been miserable for the last, at least for the last 2 to 3 years, they have cash problem, they have investment problems, they're being really hammered in the United States, they got practically out of Europe, they're being challenged in China, and there is no plan in front of it. So I can tell you that there is panic mode inside Nissan.
You've dealt with the Japanese, you've dealt with Nissan, you understand the metrics to get these organizations together. Is the government going to have to deliver backstops to Honda to make this deal work?
No, I think they in a certain way tried to push Honda onto this deal. Obviously, Honda must have some kind of benefit out of it, if not on the short term, at least on the mid and the long term. But that will be closely monitored to make sure that the impact on the Japanese society is not going to be too big. Because, you know, when you have two companies of this size and practically in the same market with practically the same strengths and the same weaknesses, there are going to be a lot of costs to be taken out, and there are going to be a lot of duplication to be taken out. So this is going to be closely monitored by the Meiji.
It's driven by the Ministry of Economy. So there's a political dynamic to this. Is this Japan creating, putting two companies together to really try and stand up to the competition from China? Is that part of the narrative here, Carlos?
Without any doubt. It makes a lot of logic. Today, the Chinese automaker are on the winning side. They became, as you know, the largest exporter of cars. They are the largest maker of EV. They are being successful in a lot of new technology. They're doing fine cars. So in a certain way, yes, it's a defensive mood. It's a defensive mode that's going to be trying to shore up the Japanese industry and avoiding a cataclysm, first a social cataclysm in Japan, and particularly to try to reinforce these companies on the foreign markets.
That was the former Nissan chairman, Carlos Ghosn, speaking to us December 20. But in terms of the market reaction, well, of course, we've seen that really being expressed in Nissan and in Honda. It could be really one of the biggest M&A deals as well over the coming year. But what else we're really tracking today is bond market activity. It's been a bumper year for Chinese bonds. In fact, the best going back to 2021. Yields are are moving a little bit lower this morning so far. Remember, of course, we had those PMI figures reinforcing, yes, we're perhaps seeing a bit of a pickup in the services sector, but the expectation for easing is very much still intact. And again, that's what you've really seen expressed in bonds, and as well the PBOC shifting to a monetary loose stance.